Welcome to a new video. Today we're going to talk about the standard deviations and power of 3. So for the correct use of these tools, first we need to know the fundamentals, the basics. So let's start knowing what standard deviations do, which each level, and what to expect inside and after that level. So first of all, we have our anchor points, which are the start of our Fibonacci tool placement, which is standard deviation. These levels are 0 and 1. These ones will be placed on a swing high and swing low on the last price leg of the manipulation. What I mean by a manipulation leg is the last movement taking liquidity. So in this sort of example, the liquidity resting in the accumulation is right below these lows. So the last price swing leg, like swing high and swing low, will be our manipulation leg. So we place a standard deviation from swing high to swing low, and then project higher as the manipulation was made on the lows. If the manipulation would be above on the buy side liquidity, we will be expecting some move downwards instead of bullish. So after we anchor these points, now have our next group of standard deviations, which will be less 1 and less 1.5. Less 1 and less 1.5 are our silver bullet zone. In this zone, price will seek to rebalance an inefficiency to continue his movement. This zone, it's a good zone to place your trades, because it will be the reaccumulation or redistribution on a market maker model. So usually this can fit either on the first leg or second leg. This example, just for terms of explanation, it will be fitting on the second leg. So why this zone is important and it's relevant, and I can trust in this zone for taking some trades if we are on the right drawn liquidity. First of all, because we don't play on the risk on all this price, that price can maybe trade against us. So if we wait till price comes down here, we will be already on the distribution phase on a accumulation, manipulation, and distribution model. So it's a very it's a very safe zone. Sorry. So we just need to wait for our retracement for then take our entry. We could be searching for some buy stops, some inefficiency, or some OTE. Usually OT will be rare in this zone, but you can also have an eye on that. So our second is less 2 and less 2.5. So let's say we have now placed our trade inside some inefficiency right there, and we will be now searching for an expansion to the sell side, as we're on a market maker sell model or AMD, bearish AMD example. We will be expecting some expansion to less 2 and less 2.5 deviations. What can we expect on this less 2 and less 2.5 deviation? We can be expecting some retracement or some reversal. In this zone, price have already completed his mission, in my opinion, so I can not longer seek some trade. If I am already entered on less 1 and less 1.5, I'm already out or already leaving some runners to take some partials and be searching for some more profits, but I'm already out of risk. This is not a magic tool, so we want to be seeking some drawn liquidity, our original drawn liquidity. So in this case, the original consolidation as well can be at some inefficiency, some buy stop, or some sell side. After we close above less 2 and less 2.5, like on this scenario, after we close with body after above less 2.5, we can now be expecting a double expansion to less 4. So now the less 2 and less 2.5 standard deviation level goes as a second stage of our cerebral bullet zone. We can be expecting as well some retracement to go expand to less 4 deviation. So going back again to our example of entry on less 1 and less 1.5, let's say we target some 2R to the sell side liquidity. If I already got some 2R trade, I would either close or leave partials, as I just said, but I would always check if price have some unfinished business on less 4, some reason to go to less 4 to maybe let some runners, otherwise close the full position. If I'm honest, a lot of the times I just close less on the less 2.5 deviation or less 2. Whichever the level fits with a higher time frame PD array, some drawn liquidity. This is the original consolidation, as I just said. Using now less 2 and less 2.5 deviation as our second silver bullet zone, we can be expecting the same things. Rebalance and inefficiency, take some sell side, take some buy stops, or have an optimal trade entry. After we close above, now we are expecting some less 4. And what can we expect on less 4 deviation? Well, on the less 4 deviation, it's the end of the move. We don't care anymore if price can be expanding more from less 4 deviation. Why? Because we have a system. We already make profits. We're some mechanical traders. We don't want to be expecting nothing more that can be an uncertain result. On less 4, we can also be expecting some sort of turtle soup once we reach their deviation, until the less 4, the cycle it's over. Now, what if price don't expand above less 2 and less 2.5? So we can be expecting some deeper retracement or a complete reversal. What do I mean by deeper retracement? Well, on this movement, we will be making some structure. Let me frame it around here. So we have the manipulation leg there. We'll be scaling up till there. We'll leave it for a moment there. We will be leaving some sort of structure. Is leaving some dealing range. So we will be now having some discount and premium. So once price reach our less 2 and less 2.5 and don't close above with bodies of less 2.5, will be now expecting some retracement if I will to see some continuation or higher prices in this case to the equilibrium of the dealing range of the market structure. Price leave us, so can go deep to discount and then continue. This happens a lot of the times, not always as any other concept, but the retracement after less 2 and less 2.5 it's hit and go to equilibrium, it's likely, but I wouldn't be taking some sort of position around here because it would be very risky in my opinion, because price can perfectly continue running down and ignoring this dealing range. So initially I would be waiting for clear some liquidity, react from this discount, make some market structure shift, some sort of change in state of delivery, SMT, something that confirms me that price is willing to go higher again, expand for higher prices. So I would wait for price to print and tell me where I can be entering on this deep retracement. So in a power of 3, each delivery phase can be measured with the help of standard deviations. If you select the right drawn liquidity and if you select the right range to measure the next range. Remember this, as your next range of a standard deviation will help you out to measure the next standard deviation. In this case, we have the manipulation leg of the accumulation, which will help us to measure the manipulation of our AMD. After we have the manipulation, we can measure the distribution. Now, we have multiple standard deviation placements. We can measure standard deviations using breaker blocks, low, high, lower low, higher high, and lower high, making this the retracement. So we have this formula. This would be the breaker, a bullish breaker. So we will be going to measure standard deviations using breaker block from A to point A to point B. Okay, this is point A and our point B. We will be placing from swing low to swing high. So A to B. This will leave us some short-term standard deviations, but are also valid. Almost all the standard deviation will be used on the same format. So let's just keep this same format, just duplicate it. So using the same format, we also have our manipulation leg, which will be this. Cloning this once again, we'll be having some first distribution leg placement will be from here to here. So we have these three forms to place standard deviations. We also have some mix using wicks, sometimes using bodies. I haven't figured out 100% when to use each. My theory, and which I will be sticking for till I'm 100% sure, is that if the manipulation leg is formed based on news release, such as 913 UDAS or something like that makes some large wick, the wicks do the damage, the bodies tells the story, so don't use the wicks on that cases. Otherwise, use wicks and always search for some array. So we have these three ways to place a standard deviation: from breaker, which I rarely use; manipulation leg, which is my favorite, and my second favorite, and the one I stick if the manipulation leg is very, very large, I use the distribution. So using back again to our example, I use the first leg because this will be the manipulation leg. In here as well, we're going to have our breaker block. But by teaching these three placements, I don't want you to have like 100 standard deviations in your charts. Just keep it clean. Have as much as 2, maybe to find some overlapping, but we're going to talk about on a further part of the video. Now, if you notice where I place our standard deviation for catching the distribution, it's on the smart money reversal. If you don't know about market maker models, if you want, so I could be explaining it on a further video. But for the moment, this will be the manipulation part, the smart money reversal, where we also be likely to form a breaker block or find some SMT. These placements will be the highest probability. So we already going to, we always want to go for some top, like some higher time frame PD array taken, and then place the standard deviation. Knowing all this stuff, we already know a lot of standard deviations and the fundamentals to know where to place the standard deviation. Now, when we're going to go to the part of when we're going to place the standard deviations, what is power of 3, the fractal of power of 3, and how to mix them more in charts.
So let's now talk about open high low close and open low high close. So it's a very simple concept yet so powerful. And on the left side, we have our bullish example. On the right side, our bearish example. So let's start. It's very simple and very basic, so you might know it. So we have this is our open. This is our low, open, low, high, close. All the body is the displacement, all the movement, all the distribution that the candle of whatever time frame it is made. So open, low, high, close. All this displacement. Same for the bearish, but change a little bit. So open, high, low, close, all body displacement. Very simple and powerful.
Now you know about open, low, high, close, and open, high, low, close. Let's see it now on a daily power of 3, which each session function about on power of 3 terms. So we have Asia, that it's known to be the accumulation of the day, where it might be some sloppy movements. So we have the accumulation, which is Asia. Then we have some dead spot till London Open. London Open, and London, it's known to be making the manipulation of the day. So it's our accumulation, manipulation, being London. Then we have New York, which might be the distribution of a day. So we have accumulation, manipulation, distribution. We have the manipulation leg of London. This is a very perfect scenario. It's very rare to see one of these daily basis. And if you are going to see it, it won't be that perfect. So it's all more about eye training and knowing what to expect on a more real scenario. Just giving you the blueprints how to use this. So London usually will be the manipulation today. As we said, the previous standard deviation works to measure the next standard deviation. So we have our manipulation leg on our manipulation session, London. We project down till less 2 deviation. We will be searching here some sort of PD array. In this case will be some sort of fair value gap, say. And after we tap in it and complete our manipulation measure, we will be now expecting our distribution. We project lower after we have our manipulation leg on London. Project bearish to complete our A and D. Targeting some internal liquidity or some external liquidity. price just moved between three things: internal and external, and equilibrium. So we have internal liquidity, which are fair value gaps. We now have another manipulation leg. We project standard deviations. After we close above standard less 2.5 deviation, we can be now expecting a double expansion to less 4. We can be entering some trade in our serval bullet zone, less 1 and less 1.5. Searching some fair value gap, OTE, buy stops, whatever. You can have an entry here. That's just for pure education and explanation. Let's just make it a bit more perfect. So we have here our entry. Then we expand, targeting our buy side liquidity of London inside our less 2 deviation, less 2 and less 2.5. So let's say, I don't know, here, stop loss out here, you target here. Obviously, you're probably going to get some better risk to reward explanations. So you have your trade there, you could close almost all your position there, then leave stops at break even, leave runners to less 4 deviations. Could be some daily power of 3. So we measure the low of our open low high close. We measure the high of London, as we will be making the manipulation, and then we trade the buy side liquidity that London. You can also be taking some trade inside this zone. If you trust the model, if you identify some other things, maybe some unicorn inside here, or you can, if you trust with this market maker buy model, you can also be taking some position on a low risk buy, or waiting till this standard deviation gets hit. It's up to you. Let's now jump on devil mark. What is devil mark? Devil mark will be basically shown as a power of 3, or a same power of 3, that can be shown like this. So probably our power of 3 will be looking with a very small wick, a very small part of our open low high close, or our open high low close, whichever it is. You have to have some criteria on what is our wick on a power of 3. So on a daily power of 3, it's very rare that you are going to see a very tiny wick, like a very few ticks, pips, whatever. So price could be potentially be searching for print a larger wick, or can also be some power of 3 that is with no wick at all. If we see this a raw schematic, more sketchy, let's suppose we are seeing price from here. From here. Until this moment, we are seeing price. Our power of 3 candle will be looking just like this, with no wick. So with no wick, we can be expecting some potential drop, some bearish in this case, or print the low below the opening price, which is on our 4-hour power of 3, which this opens at 10 a.m. on index futures. I don't know if also works same on commodities. But for Forex, you have less 1 hour, so the open would be at 9 a.m. I don't know how well this model or devil mark works on Forex. I just know them and use them indices. So until this moment, our power 3 is missing the week. This is what I would call the devil mark. Well, Dexter and all the Monster Lab members call devil mark. Okay? Which means is that price will be pushing to print the week potentially, not the 100% of the times, will be printing the week if you backtext only the devil mark to see how many times it fills and create the low and grab the data to have more trust on the devil mark. It's awesome, but I have seen them work a lot of times. So now we know that price could be bearish if our devil marks align with our higher time frame institutional order flow. It's more it's higher probability as we are going to trade with a higher time frame narrative. So we'll be taking some entry for the short, and that's it. Very simple devil mark. I have some example here as well. Here on Nasdaq, we have some devil mark on our 00H4 power of 3 model. There is a missing week on 1000 power of 3. We see price first rally up and then drops and come to print the week. So until this moment, on this very drop candle that prints the week, the devil mark, it's already gone. Very simple. Like some other example. So here we have another NQ example of devil mark on our 700 AM open candle, which would be an 1 hour power of 3. You can see here it's a missing low once again, but this time the devil mark fails to trade it and print it. Why I don't count this low to be printing the devil mark? Because if it's a 1 hour power of 3, this means we have 1 hour for price to print the low. After that, that devil mark it's cancelled. So 7 to 8 a.m. no devil mark. This is a failed devil mark. Probably you could potentially take some lose from loss right here. But once again, not every model, not every concept works 100% of the time. So you have to make it to your own criteria and have some judgment. Let's check some other examples. This was shared on Twitter. Very much about this. Check it out. Would be linking it on description. But let's go to the important, which is devil mark. Our 1000 open doesn't have wick once again. So this is a signal of devil mark. Price prints, reach standard deviations, notice, accumulation, manipulation, fusion. Why I don't take this manipulation leg as is the most recent, but it's a very short term, not what I would prefer. Also, it's different on other time frame. Remember, it was on 3 minutes, so it was just like singular movement, some singular manipulation leg. And we have our overlapping standard deviations of our higher time frame, our main range. So when you have overlapping standard deviation, is that you have standard deviations inside the standard deviations, and your range decreases to be more precise on where price might stop out. The overlapping standard deviation close to from here to here, from less 2.5 main range to less 2 of our inside range. So as it's a 4-hour power of 3 open, we have 4 hours for price to print the low. Price prints the low after going higher, then drop, higher, dropped until the double mark was complete. You can take some trades on double mark, or you can just use them to know where price can be printing out and write it out, or just to study it to know why price is just dropping like that. And yeah, basically is that it just go up then drop to print the double mark of the h4 power of 3. That's it. Here's another example again with 10.00. We have our, this can also be qualified as a manipulation leg, probably the deviations fit or nearly fits. We have a missing low of our 10.00 open, our h4 power of 3. This means we have 4 hours for price to print the low, and price goes up and down to print the low of the 10.00 h4 power of 3 open. That's simple of the devil mark. So now we know how to place standard deviations, how to measure each phase of a power of 3, where to place standard deviations. Let's talk about the fractal about power of 3. If you know, if you have been trading for a while, you might know from H4 time frame, all the time frames above are higher time frames. So H4 is a relative higher time frame. So we have power of 3s on every single time frame. This means we have 15-minute power of 3, 1-minute power of 3, 5-minute power of 3, 1 hour power of 3, etc. Why we have a power of 3 in every single time frame? It's just because that's how price prints. Because price prints with wicks, well, with candlesticks. So candlesticks have wicks and bodies. The bodies are the distribution. Wicks, depending on what candle we have, is the manipulation, and the opening is the accumulation. So each candle have a power of 3. Doesn't mean you have to trade each single time frame power of 3, each single candle is an opportunity to trade. No. You can measure some long-term and short-term power of 3s. So let's talk about the H4 power of 3, which is the model I use. Got introduced to me by Dexter, Twitter. So this is the model for our power of 3 that he presents to us. If we analyze this to the precision, it's almost everything I have teach to you right now, just on a fractal schematic. So we have the 10.00 power of 3 open, H4 power of 3 open, then opens, accumulation, rallies higher, manipulation, distribution. We have our standard deviation placement on the manipulation leg, on the first distribution leg. So probably won't fit in, but the placement would be either here. The placement on the standard deviation on this scheme would be here on the first leg of distribution. Yeah, I know it doesn't fit, but just a random example. we want to be seeking some sort of SMT, and SMT is a must. Is if you want to take just high probability trades, if you don't have an SMT in your trade, it's decreasing the probability that you are right. If you want to know more about SMT on the educational channel on the Discord, I have some SMT as well some Twitter threads of some guys of Twitter that are very useful to help you more understand more about SMT and turtle soup. So we want to have some SMT on the highs, on the manipulation part. Then we have our low risk sell on this case, our first silver bullet, our first entry, our first leg of accumulation, of distribution. Then we have our second leg of distribution, which can be entries. So we must want to have some SMT, and here the model says avoid NFP. NFP because it might be low probability, won't work as well, and that's it. So we know that each candle have a power of 3, this meaning H4, H1, daily, weekly, monthly. Let's go and see some examples. So here we have our weekly power of 3 example. Very superficial analysis, very simple on the weekly power of 3 and with 1 hour time frame. So in here we can see we have a not usual accumulation, but if we use weekly power of 3 terms, remember I said it was fractal. If you know that sessions are known by some sort of movement, such as Asia accumulation, London manipulation, well, on the days of the weeks, you can expect the same thing. That's why I don't like to trade Mondays. Yet can present some opportunities, but you can't hold trades as much as can be some seek and destroy profile, as Mondays will be the accumulation of the weekly power of 3. The accumulation will be always near the opening price. So you can see here the weekly opening price opens here. Monday stays near that opening price, which leads to some accumulation. Then we have our manipulation leg, clearing all the sell side liquidity that rests on the manipulation. It was a swing high and a swing low, projecting to less 2 and less 2.5 deviation. We result with our manipulation. Here is the all-time high, so we could be maximum standing above here. So minimum here, above here, it's more manipulation. We leave another manipulation leg, and we can now be projecting the distribution to the downside to less 2 and less 2.5, clearing the accumulation and manipulation movement liquidity. So all this low resistance liquidity will be cleared up till our distribution phase. Very simple, very fast. Now you know how to apply power of 3 and standard deviations, the opening prices of power of 3, the fractal of power of 3, what to expect in each session of power of 3 terms, how to measure it, the movements of the power of 3. You know devil mark, you know the multiple standard deviation placements, what each standard deviation do. So let's now make some analysis this week. First of all, we will be going to Forex Factory to check the news calendar and check what our trading days are. So this is the news calendar. Monday, it's a bank holiday, so no trade on this day, as it will be the accumulation usually, and with bank holidays, low probability day. I usually also don't take trades the day after, so I would be also skipping Tuesday, even though are news, but the day after and before in bank holidays are low probability. Now we have these 3 days resting. For this model, you can be good taking some one trade per week, 2 trades per week. You don't really take a lot of trades, as it's very sharp, and I like it a lot. So we have 3 days to take trades on this week. Now, if you know about previous day highs and previous day lows, you will know that you use them to have a clear bias. Let's explain this very quick. In a previous day high and previous day low, what can we expect? For price to expand and take the next high, right? So in this case, we will be just expecting previous day high to be taken. So we take the previous day high. We take previous day high, and we can be now expecting previous day high be taken. We yet don't make some swing high to be shifting to searching previous day low. Yet we will be likely to be taking previous day high again. We take previous day high and previous day low, making this an inside candle. Now we have we cleared this liquidity and take both buy side and sell side of the previous day, leaving a potential swing. And why this won't be a potential swing? It didn't sweep any liquidity, didn't take any liquidity. So I will be now searching previous day low to be taken, then previous day low to be taken, then previous day low to be taken. So using daily swings, you can be expecting the 4th day of the swing. So to make a daily swing, you need 3 days. So day 1, day 2, day 3. The day 3 low, it will be potentially be taken by the day 4. This meaning that a continuation on the same trend, it's likely. So after day 4 takes this low, we can be seeking day 4 and 5 to continue with the same. This applied the same on this equally on the bullish scenario.
This same thing applies to a weekly power of 3, a 4-hour power of 3, you name it. If you notice, in this daily time frame, some previous day high or previous day low was taken, except for this day that was a undecisional candle. So knowing where the next power of 3 or your current power of 3 will expand, it's key to know where you could be placing your trades, your bias. Jumping now with one of the last examples we're going to be presenting here. I want you to know first one very important thing, that power of 3 can only expand into one direction. This means on a daily power of 3, the power of 3 just can do 3 things: either expand taking the previous day high, or taking the previous day low, or chopping around. It's a seek and destroy profile if we don't take any of those previous day highs or previous day low. So where our main focus on every power of 3 is to know where it's likely to go expand now. So Knowing this, we mark our previous week high, sorry, and we open our uh, news calendar to know what days we can trade, at what time we can expect some news release, so we can not trade that time. So Monday is bank holiday. I usually don't trade Monday, even though like this Monday it's bank holiday, so it's very low probability in my opinion. And I usually don't trade bank holiday because if you look Monday in a power of three schematic, it's the open of the weekly power of three. And with every power of three open near the opening price will be choppy, more slow, will be the accumulation part of a power of three. So Monday will be the accumulation part of a power of three. In other words, the Monday, it's the Asia session of our weekly power of three. So we have weekly open here. Mark up. Next, I don't like to trade the day after bank holidays because it can still remain a bit choppy. So I would skip the day. Plus, as we can see here, where we tap again to the opening price. So again, more money, more accumulation, leaving here sell side liquidity and buy side liquidity here. Using the understanding of this video that I just give to you, now let's add on one more thing to the standard deviations, is that each range work to measure the next range. What I mean by this, when you place a standard deviation, either is on the manipulation leg or distribution phase, you that range you create and that projections, if it reach the projections, you will have your next range to measure the next phase of the power of three almost within the same projection. So we have here the example, if it's not clear. So all this is the accumulation. Then we have this movement up, breaking and grabbing all the buy side liquidity. Then we have here our first leg of distribution. We have here our first placement, a standard deviation. Why I don't place it down here? Because it's too large the range, and it would be very ambitious, very rare to see an expansion, a large expansion. So it would be very unrealistic in my opinion. Plus, we have here near sell side, and I think we have some higher time frame fair value gap or something. Yeah, we have a fair value gap here and an order block. So let's jump back again. So this is our first range we are placing. And this range will help us to measure the next range. So first placement on the distribution leg, react to less 2 and less 2.5. And it fits right here. But let's start with the day. So I first want to mark the daily open for the daily power of three to have the discount and premium of the day. Buy below the opening price, sell above the opening price. So as we can see here, it's no wick, so it would be a devil mark, but a failed devil's mark. It's no wick above here. Once we mark the price of the midnight open, I want to mark as well the 9:30 open, equities open. Because if you go into regular trading hours, all before 9:30 and from 60 to 9:30, you will have a gap. But I don't want to mix that stuff in this video. So 9:30 more important to me rather than 8:30. 8:30 I will use it more on forex, not indices. So 00 9:30 and 10:00 for our 4-hour power of 3. We have our news calendar. We have news release at 7:30 a.m. So we are already trading ahead news release, so it's no problem. And we have our projections. I would wait for the 10:00 to open the most of the times. If nothing, it's very clear to me on the before in 9:30 open, which I rarely take a trade in that time before 10:00. So if you drop to lower time frames, your standard deviation placement change. You can see you have a placement here on first distribution leg as well as on the manipulation leg. But as I said, I don't want you to your charts looks like this, like with hundred of standard deviations. That can do more damage rather than help. So I was considering this situation, all the liquidity resting above the previous week high, I would place the standard deviations on the manipulation leg, targeting the weekly open. You can see here. Or if you want to be more less ambiguous, less greedy, I don't know, place it on the first distribution leg, and you could close it when you feel comfortable, or just target in today's price action of this example, target the buy sell liquidity. Remember where you place your standard deviations will often change and decide your kind of discipline you want to place into that day. So you can place a standard deviation on a very hard time frame or with a very large manipulation leg, but that can um, give you a different projections. And if that projections and your drawn liquidity are right, like your drawn liquidity and projections fitting, that will tell you you could be okay. Also, remember to trade always with higher time frame institutional order flow, as you will, if you trade against higher time frame institutional order flow, will be low probability trades, as you can just catch some retracement. So same situation. If you drop to a 3 minute instead of 5 minute time frame, you have another manipulation leg. So I will target this first high, either this one or this one. It's a bit irrelevant. And I would like to know if an SMT is on play. So maybe don't take some break even here. If so, maybe some partials you will have be already taken, so you'll very be good, because partials it always pays. So let's check out if yes did an SMT this day. Check real quick. Have here around 11:45. Oh, so it could be some SMT here. So probably would just close it once I see this SMT and start seeing this rejection, this displacement of this level. I would close the trade in this candle. I think I got it. If I have the example, I would be, if I take the trade, I would be pasting it on the video. But this was very clean. As you can see, you have 10.00 here and 9.30 around here. So you would be on double premium. Remember, you can also take trades, partials or close trades on opening prices. What I mean is you could take some partials here or close the trade here. So remember that. All the price below the 10.00 will be our manipulation of the 4-hour power of 3. If you can see it more with a larger scale, this would be our low of the week created in 10.00 inside of our less 2 and less 2.5 standard deviation projections. So we're targeting there. Now, if we have some sort of, I want to drop this, if we have some turtle soup, the most of the times we will have a breaker block. So turtle soup and breaker block go almost by hand. And if we reach the less 4 deviations, we can have a turtle soup the most of the time. So turtle soups, then you have a breaker block. In this case, we don't have turtle soup and we don't have a breaker block. So I would be seeking maybe letting run price to see if it's really willing, as I would like to wait more of the manipulation to be developed, because with this model, what I found you need to be careful of is that you can be faked on taking the manipulation part of the power of 3. So maybe you could get faked on this part and you will start to short and you will be just part of the liquidity. So I would give around 10 to 15 minutes most of the time to see if price is still around opening price. If it's still around opening price, I would either close or decrease risk to be more careful, more on a defensive position, because often will be low probabilities. This is what I have been seeing. I don't know if some research or some backtest data behind it, but that's what I've been seeing. If the power of 3 spends a lot of time on the opening price, that tells you will continue there or be just bad price action. So I would wait around 15 minutes, 30 minutes if you want to play safe. If you want to be very certain of your model, just wait, place your standard deviation of the manipulation leg, wait for silver bullet, and just take the trade. Here it's very simple to see the trade. So you have all this CB, all this CB, and we can reduce it down to this, making a BPR. Making a BPR, so you could be entering here inside of our silver bullet zone. So this could be your trade. Maybe placing a stop loss around here. Here. As you wouldn't be getting tagged, maybe taking some partials on your rejection block. Or closing the trade. And you will be getting a 3 risk to reward. If you, let's say you didn't close the trade, neither take any partial, you still be getting, if you close the trade on this change of state of delivery, if he could say so, because having here the SMT with ES, and then we break this swing low, it's telling you that price might not reach your destination before stopping you out. So still, if you close the opening the trade, it would be in around 1 to 1. So it's not bad. You don't take a trade an L. So you have this BPR. I would wait a bit for price to start developing. So let's say this is our change in state of delivery. I think I remember this trade, and I take a first trade around here, but I close it almost like here. And I recognize the market maker model. So I wait for inverse fair value gap, and I take the trade on here. So it was still very, very nice trade. I think it was something like this. And yeah, I closed the trade around here. Also want to drop this. A high probability inverse fair value gap will be when that CB or BC, previous to become a inverse fair value gap, support price. So you can see here that price leave this CB, then come back up, retest the CB, reject, retest the CB, reject, and then break it. So this can tell me that the inverse fair value gap will be valid. If you want to play more safe with taking less emotions, you can also be to not get FOMO. You could be trading inside this inverse fair value gap. Let me place it on some orange. And inside this fair value gap. Oh, inside that fair value gap. So you could just wait for price to come to your buy limit and take the trade. If you don't enter the trade, you are good. You continue with your day, close charts, or jump and wait for another opportunity. So the model presents a lot of opportunities. Maybe not every day, but at least once a week you can see a power of 3. And I'm just teaching the things that Dexter from the Monster Lab have been teaching on his YouTube. And this power of 3 of 4 hour, it's very powerful, as it will fit most of the time with your silver bullet zones. Silver bullet zones, sorry, the silver bullets time windows. So 10:00 to 11, or 14:00 to 15, I believe it's. So here is another H4 power of 3 candle. And this one hit your standard deviations as well. Maybe you can place another one inside here or something. Let's continue with this. So if you wait for price to rally and start displacing on +1 and +1.5, you can have a safer trade, a less risk trade. And if you don't feel very comfortable or don't trust the model a lot to reach +2 standard deviation for this example, let's say you enter a bit lower, I don't know, maybe here, and stop loss around here. You target this for risk to reward, and price didn't reach. I would be placing stop loss on this intermediate term high because I wouldn't be wanting for price to break this intermediate term high if institutional order flow is still with me. And because it's fitting almost barely fitting with less 1.5 deviation. And inside this zone, once we displace with bodies above this level, we will have our invalidation level, which means if we break, if we retrace deep inside some of these ones, it's likely either you will be getting stopped out, either for a big retracement, maybe for to discount, or full reversal. On this trade, I doubt anyone take this without getting stopped out if would be targeting from here or without closing the trade manually. Because look, even this candle didn't even reach, so you will have to wait a lot of time. And with a good risks management, sorry, and trade management, you will either take a break even or a stop either here or here. Because same, this is an intermediate term low, sorry, intermediate term low, not intermediate term high. So, because it's inside a fair value gap, it's rebalancing this fair value gap. So, this intermediate term low, intermediate term low. Once these are violated, says that price institutional order flow, it's not with you. You need to be very careful with this model because you can be often, you need to be more in control of your emotions, be more patient for wait for price to start developing. Because as I just said, you can be hesitating to taking some trades on the wrong part of the power of three. You will be catching this more often with practice and eye training, as will be getting easier and easier. So let's jump on the next day. We have news release 7:30 once again. We are near weekly open. We have 00 here. Once this price developed, we already should have placed our next dealing rate. Sorry, our next standard deviation projections for our two resting days projections for the distribution of the power of the weekly power of three. So we mark 00. We barely have a manipulation. I don't take trades before 9:30. So 9:30 open. Blue. 9:30. And then 10:00. So we have our time opening timestamps. Very important. We are already on the distribution of the weekly open, of the weekly power of three as we expand higher. What I wouldn't consider that in this day we're already on the distribution part of the power of three of the weekly scale, because day after bank holidays we tapped again on grabbing all this liquidity. Overall, you could just take an L, an unfortunate L, and then recover on the rest of the week. So let's play some realistic scenarios. You could potentially someday take this as the distribution and just being wrecked for the price action. But if you identify the model correctly, you will have a good resting week. So we have our previous week high, which is this, let's place it as red line. So this could be our buy sell liquidity. Let's try to drop on a lower time frame. Here. So 10.00 open. Then same situation. I would like to have a double discount. So we have 10.00 on discount, 9.30 on discount. Notice how it's this reaction, but is respecting the opening price. We have a turtle soup here, potentially meaning we have a SMT with some asset, either here or maybe lower. Because soup, it's most of the times by hand with SMT as well. To detect the breaker block on these types of price action that it's a bit more choppy, I would like to go on a bit higher time frame to see the structure a bit cleaner. So you can see here low, lower low, high, and higher high all the way till here. So I would wait for price to come down, reaching as well our 10.00 discount. Because you could get easily chopped out in this zone, maybe taking an L, even though our buy sell liquidity was already taken. Let's see if some projections fitting. Too ambitious projections and then taking a loss. You have to ask yourself a question on what amount of risk to reward I'm happy to take. So maybe you are very comfortable with this what with this trade. What? Okay. So maybe you're comfortable with this trade and you are done, not even needing the projections. So it's more of your judgment. As you can see, not every model, not every projection will work. No model, no projection will work the 100% of the times. So in this case, the less 2 projection of the 10.00 failed. Maybe it was a bit on the other side. No. So if you are good with 2 risks to reward on the long term, it's very nice. So this would be great. Let's jump on the next day. On here we have another failed table mark. You can see the 14.00 for our power of 3 have no wick, but the devil mark fails to tap again, so it didn't come back to continue. So this is why I don't, if I see a devil mark, I short or buy in immediately. I want to have some judgment. It's like, do you really think price will come down to here once it displays all the way to here? Would be weird, more in the time resting of the session as a bit around above 1530, it will be start getting a lot of choppy. And you can see as well here we have some simulation. Could be this or your manipulation. And this the distribution. What else is here? A market maker by model. So you can see here what is more powerful, an ongoing market maker or a devil mark. So it's more on your judge and waiting what you like and you are expecting. So in this market maker, the opportunities are a few of opportunities. First fair value gap. Let's see how tidy this is. Will you get tagged? Yeah, you would get tagged, barely tagged. Here, I wouldn't take this because it's very tight the body displacement of the inverse fair value gap. So let's see another opportunity. Just like heavy market, like the only one would be like this institutional order flow entry drill. Here, like you get tagged there, stop loss maybe there, or 2 risk to reward. You can see here, even on the 15 minutes, what you have here. It's swing, so you can see it like this. This part creates a swing, swing, swing. So now we would be looking for some bullishness. Let's mark the same things. Have our timestamps, the one we are interested into. Drop back again on the 4 time frame. You can see it's been a bit choppy. As I said, I like to wait for the power of 3 to develop around 15 or 30 minutes. So here would be 15. Here would be 30. You can see price is already making the manipulation leg. This case would be this. Let's check. We have news on 9 a.m. Let me check. 9 a.m. but it's on my times, so I think it's mixed up. Let me take a quick look. I think, yeah, on my time. So would be the news release on 10:00. So all this week, I wouldn't consider it as the placement. I would place it on the bodies as it all this by news. Then I would search for some overlappings, which we don't get because it's very high. Maybe we have a overlapping, almost barely overlap here. How about this? we have here less 3 overlapping standard deviations. So I would be targeting here. As we already know, we are on bullish. I wouldn't be even searching for any buy side liquidity or value gap. We are already displacing higher. Plus our higher time frame institutional order flow to get all-time high. So would be weird to get a burst for the end of the week. So we wait 10:30. You like to, if you would like to wait all that time, or maybe take some entry here. You can even take some entry here, even though the fair value gap was disrespect. Like on live charts, you wouldn't know, so you maybe have some trade like this. We have SUP as well, maybe SMT with this or the one above. Meaning we also have a breaker block, low, high, lower, low. Our higher high, it's created all the way till here. Here's our breaker block, bullish candles. Oof, we didn't get tapped, would be all this. We didn't get tapped on NQ. Let's see if on ES. Sometimes price reach a PDRA in one time in one asset, and in the other one it doesn't. But on ES we don't have the breaker block. So we didn't have our entry filled on based on breaker block. So I would wait for the silver bullet zone. Be all this gray base. Let's search now for a NIF fair value gap. This fair value gap is not inside of our silver bullet zone. We have here a C inverse fair value gap. I would probably take the trade here. Why? Because it already holds price here 2 times. Maybe take the trade here. This is stop loss. Yeah, on the intermediate term high. Target here. So let's do standard deviation. Sorry, let's do risk to reward. Maybe you can leave some runners. Based on the projections we had on the dealing range of here, I don't know, let's say we are with 5 micros. I would close 4 here, place our stop loss or around here, because it's on our invalidation zone. I wouldn't like to price to come down here. And let the rest runners to less 4 of here. Would be very unrealistic to let runners all the way to here. You trust? I mean, it should go there with, as we are expecting a double expansion, but you really need all that gain. It's like sometimes, even though you know the drawn liquidity, you take some else of not taking the trade, and it's good. Because not even though you know the drawn liquidity, you need to take a trade. and not because of knowing the drawn liquidity, price is going to do what the drawn liquidity that you think it will be, the movement of the market. So it's always a margin of error present. So you can get stop out, maybe, but would be weird. As you displace above here, maybe if you can't be on charts, place some alert once it displays above and start and rally the stop loss on here. I wouldn't like to come back to the range. And then take the TP on here. And would be a very nice trade. 5 risk to reward. And if you would be very ambitious to leave some runner, would be a one micro, one to 8 risk to reward. If I want you to take something of this video, it's more patient. If I have learned anything about this model, is that you need to be patient with the model. If you are not patient with the model can still develop without you. And maybe your drawn liquidity was right, but you hesitate and you enter the trade early. So be more patient than the usual. You need for the power of 3 to dictate you what your next movement will be. Because if you hesitate, you are going to be the manipulation of a power of 3. Then, not because you have a lot of standard deviation levels or a lot of standard deviations, you will have a better drawn liquidity. Your drawn liquidity, it's essential. Then you place the standard deviations as a confirmation. So here I use if two standard deviations, extra, less 3 and less 3.5. I use these ones to be less ambitious. For example, on less 4, I would like to have a range almost like on the less 2 and less 2.5, like here. If I don't have any buy side liquidity or sell side liquidity in this zone, and I think and I see on unfinished business, I would activate this one, less 4 and less 4 and less 4.5. After this, I don't want to be taking trades, and taking trades above less 4, it's already like taking trades above less 4 is very risky. But if you take a trade in here and you hold all the way till here, if you are not a swing trader, or I don't see any case on doing that. If you want some further explanations of something that I could not explain very well, or you have some doubt on it, don't doubt and let me know on the Discord. Tag me out and I will answer the fastest I can and try to help you out. Maybe on a video or making a Discord call. And would be all. If you reach all the way through here on a large video, needs a lot of discipline. So I know you can make it. Everyone lacks discipline, not because you said discipline. Not because you said you have discipline or you the other ones to have discipline doesn't mean you have discipline. The discipline and being consistent without being pressured by the market or by your own mind, it's not that easy as the videos apparent. It's a part of where I struggle right now, not more on the theory, more on the knowledge. I think I know what I have to do. What I struggle is on the psychology part. So I would say always to focus on there. And if you are undisciplined on your life outside of charts, you will be undisciplined on charts. And I noticed that on myself. Times where I don't go to the gym, I'm often to take some bad trades, have over trading, revenge trading, and taking trades without any backup of the higher time frame, like all DJing trades. And thank you for watching all this far. The video I would like to stay on just for the Discord community. So if you want for anyone else to watch this video, I would be grateful if you don't send the link of the video direct, like more of the Discord, because it's more like a gift from me, from all the members inside there. So it would be a private video just for the ones on the Discord. So thank you guys and see you.